Phil talks taxes. He has been for over 45 years, and there's not a human on the planet with more experience dealing with problems on behalf of taxpayers. He wants to solve your problem, whether you know you have one or not. So if you do have a tax problem, visit our website. If you don't have a tax problem, your current tax problem is taxes themselves. So let's get into the policy issues of today. And I want to pull immediately straight from the news.
In this new beautiful bill, and I don't think anybody reads these things. I read it. I read all these bills through the eyes of small business. And I found a section in there that looks like a cut and paste that says the IRS will get extended powers to audit small businesses for up to 9 years that took the ERC. Now, that is going to cause chaos in valuations. If you have that hanging over your head, it almost seems unfair and un-American to do that to small business.
He goes on to basically say that it's not fair a bunch of different ways. But what do you have to say about the ERC?
Well, first of all, let's talk about what the ERC is. It's the Employee Retention Credit. This was part of the CARES Act that was put into the law by the Trump administration, by Congress, not the Trump administration. The Trump administration championed the CARES Act. It was passed into law in March of 2020. It was the massive COVID relief giveaway program started with the CARES Act. About $4.5 trillion worth of federal giveaway programs. One of them was the Employee Retention Credit. And this was a refundable credit that was available to small businesses if they kept employees on the payroll during the shutdown period. So there was a period of time through 2020 and into 2021 where qualifying businesses could get a cash refund from the IRS, and it was available through this Employee Retention Credit. Fall of 2023 into 2024, the IRS started detecting massive amounts of fraud, which I tied a can to early on. When you got a federal giveaway program, you are creating a recipe for fraud. All right. And so businesses across the country were duped by certain promoters into claiming deductions, into claiming the employee retention credit when they didn't qualify for it. And the way it happened is that these promoters were taking a large chunk of the refund as a commission for submitting these claims. So millions of claims were submitted. The IRS estimates that hundreds of thousands of them were bogus. And there's tens of billions of dollars. And I don't have the numbers right in front of me, Josh. I've talked about this in the past, but it's tens of billions into the hundreds of billions of dollars of fraud associated with the employee retention credit. So Congress already reacted to this, in 2023 by adding 2 years to the statute of limitations for the IRS to be able to audit employee retention credit claims. Ordinarily, the IRS has just 3 years from the date a tax return is audited. They have just 3 years from the date a tax return is filed in which to audit that tax return. All right. If they don't audit it within 3 years, they can't. There are exceptions to that. Well, Congress built an exception into the law for the employee retention credit and added and created a 5-year statute of limitations. Now they're talking about extending this again, as was pointed out in the video, up to 9 years of potential audit exposure on these employee retention credits. And so this is something where Congress has gotten very concerned because the IRS was very concerned about the level of fraud that was going on in the ERC program. And so this is going to be, if this passes, it is going to be a significant enforcement tool that businesses need to know about. And it's going to be a serious problem for businesses that potentially are trying to sell their, for individuals, for small business owners that are trying to sell, because this is a potential liability that's going to hang out there on the books.
Because essentially at this point, it's almost been 5 years since the ERC was first introduced, meaning they're trying to do everything they can to extend the possibility of going after the fraud in the system.
Well, that's true. But here's what the problem is. You're right. It's been 5 years. But what's happened is the employee retention credit applied to quarters in 2020 and certain quarters in 2021. But a business has up to 3 years from the date a return is filed in which to amend it. So a lot of businesses did not even know that they were eligible to file claims, and a lot of amended returns were filed in 2023 and 2024. So when you amend a tax return, well, you've essentially got a statute of limitations basically on that amended tax return. And so that extended time period is already out there in the case of amended returns. But now we're talking about extending it even further.
What were they? What was the meeting about? They must have been discussing something, unless they're having a boxing match. I don't think they were doing that.
Well,
what
they
were
might
they
have been
discussing?
having a boxing match because the senators that were meeting with the president are chiefly providing a lot of pushback to the president on this big, beautiful bill. So there was a number of Republican senators that met with the president yesterday at the White House, specifically talking about what they're going to do about the big, beautiful bill. There's a lot of friction in the Senate. There's a lot of different factions in the Senate that are pushing back. We can talk about what those factions are. But John Thune was the chief representative for the Republican Senate with the president at the White House yesterday. John Thune is the Senate Majority Leader in the United States Senate, and he obviously is having his arm twisted by the president to get this bill passed. So that's what they're talking about right there. A major sticking point right now for Republican senators is this SALT Act change. Now, here's what the deal is. We talked about this in our last podcast. Under the big, beautiful bill proposal, the deduction for state and local taxes will go from being capped at $10,000 to being capped at $40,000. That's a very significant increase in deductible state and local taxes that will be available to high-income taxpayers if this bill passes. All right, that translates to about $350 billion for tax savings for people largely in blue tax states, people largely in blue states, which are high tax states. The vast majority of folks in middle-income America, Josh, don't have a deduction state and local taxes because their standard deduction is so much higher than the cumulative value of their itemized deductions that they just don't need it. All right, so this most definitely affects high-income taxpayers in high tax states. Well, here's the irony of what's going on in the Senate. All right, so the House passes this cap that goes from 10 grand to 40 grand. There are no blue state Republican senators. All right, think about that. There's no blue state Republican senators. So the Republican senators are willing to give up on the SALT tax deduction, whereas the Republican representatives in the House don't want to give up on it because there are plenty of Republican representatives in blue tax states, in blue states, high tax states. We know that, right? And so this is the friction that's going on. The Senate really doesn't care about it that much. The House is very invested in it because of their constituency in high tax blue states. And so that's what's going on here. There's a lot of fighting over what's going to happen with this SALT deduction. And as I said, the Republican senators, none of whom come from blue tax states, don't want to give $350 billion worth of tax breaks to high income people that live in high tax states. So that's what's going on. That's one of the things that they're talking about.
So what's the CBO and why is it issuing reports scoring Trump's plan?
Well, okay, so the CBO is the Congressional Budget Office, all right? And anytime there's any kind of a bill, whether it's a tax bill, a spending bill, or anything, Congressional Budget Office scores the bill. And what that means is they make their estimates based on economic projections as to how much money the bill is going to be responsible for collecting, how much revenue is going to be collected, and what is going to be spent under the bill, and what the impact of the revenue collections versus the spending is going to be based on the economic models that they run. They take all the details of the bill, they put it through their machinations, and they say, okay, it's going to collect X dollars worth of revenue, it's going to save X dollars worth of spending, it's going to create, this impact on the budget deficit, pro or con. So that's what it does.
What does the report tell us, and what does it essentially mean for the bill?
Okay, so the report is telling us that according to the Congressional Budget Office, there is going to be a $2.4 trillion increase in the deficit, the federal deficit, over 10 years. All right, so they're talking about bill being responsible for about $3.67 trillion in tax cuts and about $1.25 trillion spending cuts. All right, and so that is where they come up with their $2.4 trillion deficit. All right, so in other words, the revenue lost is going to be much more significant than the spending cuts that are built into the bill, and so it's going to create this deficit, according to the Congressional Budget Office, of $2.4 trillion. Well, I'll tell you, what it means for the bill is that this is one of the areas, frankly, where the friction is coming in a lot of the senators. There's a couple of, I told you earlier in the podcast here, that there's a number of factions in the U.S. Senate that are pushing back on this thing. And there is one faction that's led by Kentucky Senator Rand Paul that's saying that the spending cuts in this bill are not nearly deep enough. And there's about 4 or 5 75 senators that are in this what you might call spending hawk or deficit hawk group that's saying we've got to do more to cut spending, and they are not going to support the big beautiful bill in the Senate unless there's more spending cuts. All right, so this is one of the problems that the bill faces. Is it's supposed to be a bill that is pro-growth and that is going to get the government debt and spending under control, and it's not coming close to doing that. At least it's not coming close enough. And I agree with some of these hawks in the Senate that it just does not go far enough as far as spending cuts are concerned.
That's the big point of contention between Trump and Elon right now. There's an ongoing feud on Twitter between the two of them. He said, kill the bill. It's disgusting abomination. And I mean, I kind of agree. It's nobody reads these massive omnibus bills. How could anyone actually read any of this? And if there's anyone who does read the whole thing, will eventually find one thing that they're like, I don't want that passed.
You're exactly right, Josh. These omnibus bills are massive. This is over 1,000 pages in length. And when they put these things together, when the reviser of the statute puts these things together and they release them in draft form, they don't have a freaking table of contents in these bills. So it's very difficult to sort through and figure out exactly what's going on. And I've poured through hundreds of these bills over the years. Of course, I've been paying attention to what's going on in Congress for over 45 years. And I've poured through hundreds of these massive bills, and it is very difficult to follow. And you're right. You're guaranteed to find something in there that's completely idiotic, that should not be in there. And because they're all of these patchwork of legislation cobbled together into this massive bill that looks like an elaborate quilt when it's all done, it is very difficult to get one thing out of there and have everybody agree to it. So there's no doubt about that. And this gets us back to the factions that I was talking about. There are a number of credits that are built into the Internal Revenue Code that provide energy tax credits. And Elon, this is one of the bones that Elon has been picking here with the bill now, and one of the criticisms that he has. Josh, there's a $7,500 tax credit in the Internal Revenue Code for the purchase of an electric vehicle. This is a tax credit, not a tax deduction.
Mm-hmm.
All right, a tax deduction is marginal. A tax credit is dollar for dollar. So this is a big deal. One of the ways that they're going to cut the deficit, I should say, is through the elimination of these green energy tax credits, the EV credits in particular. Elon doesn't like that. That directly affects his business, right? He is profiting from these energy tax credits that are built into the tax code with his Tesla business. There's just no question about that. People have a tax incentive to buy these EVs, and he benefits from that. And so he's pushing back on the bill for a lot of reasons. I mean, let's be fair about this.
I'm sure his business is a part of that equation, but let's be real here. If he cared primarily about the business and not about the cuts, he wouldn't have subjected himself to running with Donald Trump in the first place. I do believe that.
Yeah, I believe that also, Josh. I think you're 100% right about that. He didn't become the head of Doge, work for nothing, subject himself to all of the hassle and angst that he got, the attacks, outright attack, and not just character attacks,
right,
verbally, but physical attacks on his property, right? His Tesla dealerships across the country were attacked and vandalized, and he suffered millions of dollars in losses as a result of that. No question about that. He did that because of his belief that the federal government spending model is out of control and cannot continue.
And there's no question that this bill is just another example of the spending being out of control and their failure to codify any of his cuts. I mean, I'd be upset too. And then the cherry on top, of course, is that EV credit, which I'm sure is just insult to injury.
Yeah, there's no doubt about it. And he's upset about that, and I understand that. I would not have put those EV credits in the tax code to begin with. That was part of the Biden administration that put those things in. Oh, they've been in there longer than that. There've been some EV credits in the tax code going on for a long time. But this is what happens. This is an example of what happens when you have tax policy as a tool to predict or to promote winners and losers in the marketplace, right? Government, there is no constitutional authority whatsoever for the government to use its taxing powers under Article 1, Section 8 to pick winners and losers in the marketplace. Sound ideas should have a fair hearing in the marketplace, and consumers are the ones who decide what businesses are sound and need to be supported and which ones are frivolous and don't need to be supported. It is bad policy all around. down. It's certainly bad tax policy. It's bad economic policy, no doubt about that. And it's unsound constitutional policy to have the power of government decide which companies can succeed and which ones don't succeed by providing tax benefits to this company and withholding tax benefits from that company. It is an improper use of the taxing power. And we see that here with these green energy credits across the board. None of them should be in the tax code, nor should there be in the tax code any of these benefits for oil and gas that have been built into the code for all these years, right? So you got to have neutrality in the tax laws. I've maintained that all along. One of the 10 principles of sound tax policy is neutrality, where the tax policy is pro-growth for all businesses, and the consumers in the marketplace decide which businesses are going to succeed and which ones fail.
I absolutely agree. I mean, just cut the subsidies across the board and see who wins. And from there, the consumer can decide what they really want, what really works for them. And then it also takes away barriers to entry for the marketplace. But there's a couple of things we could talk about with this omnibus package, this big, beautiful bill that it still needs to pass the Senate, which means they have an opportunity to change a number of these different quilt patchwork pieces that are making it up. On the other hand, if it doesn't get passed, if the Tax Cuts and Jobs Act doesn't get renewed, what is the likelihood that we even see another tax-only bill in the coming months?
Well, it's very possible because they absolutely have to do something with the Tax Cuts and Jobs Act. That is just simply not negotiable. And the reason I say that is because of all of the reasons we've talked about on this podcast over the last several months. But I'll say it again, that if the Tax Cuts and Jobs Act is not reinstituted this year, it expires as of December 31st of 2025. And if that happens, there's going to be an across-the-board tax increase for every American in the United States, right? Every American will see their tax liabilities go up if this doesn't happen, I should say, and in particular, small businesses, all right? And small businesses will be especially hard hit because what will expire as a part of the Tax Cuts and Jobs Act, if that goes away, is the qualified business income deduction. The qualified business income deduction is that 20% deduction that businesses get basically off the bottom line of their profit, right? So if you've got $300,000 worth of business gross receipts and you got $200,000 worth of business operating expenses, your net profit's $100,000. For small businesses, that's what they're taxed on. The 20% qualified business income deduction takes that $100,000 down to $80,000, and they're taxed on the 80 grand, not the 100. This is a huge deal for small businesses. There's no question about it. And it will go away if the Tax Cuts and Jobs Act is not ratified at some point along the way here. So if this thing fails, if the big beautiful bill fails, then they have to take up the mantle of the Tax Cuts and Jobs Act.
More or less, we should hope that the big beautiful bill fails so that we don't have to deal with this entire omnibus package, which includes, by the way, a patchwork example of Bill 561. I think Bill 560, but Bill 561 is the Overtime Pay Tax Relief Act, which is not actually no tax on overtime. It's just a tax deduction on overtime that phases out, which is built into the big beautiful bill, right?
Yeah, that's exactly right. There were a number of standalone bills that were introduced into Congress as soon as the 119th Congress convened at the end of January when Trump was sworn in. There were a number of standalone bills that were introduced. This is one of them. The no tax on Social Security was another one. The no tax on tips was another one. All these things were introduced. These things were incorporated into the big beautiful bill as part of it. So the restriction or the deduction, I should say, that would be available for overtime and for tips is built into the big beautiful bill, as is an additional deduction for senior citizens age 65 or older. Now, Social Security under the bill is not exempt, all right, but there is an additional $4,000 personal exemption for folks that are over 65 years of age to reduce the sting on the taxability of Social Security. That's what that's about.
Point is that the same language that is basically calling for deductibility of overtime pay is what's built into the big beautiful bill, which is not something we would prefer to just be gone. We want the taxability of overtime pay to just be gone entirely. It seems like a bait and switch is what I'm trying to say.
I want the taxability of all personal services income gone, Josh. All right. I would abolish the income tax lock, stock, and barrel. There's no question about that. And I don't think it's a good idea piecemealing this stuff. But on the other hand, I'm in favor of tax cuts everywhere and anywhere. And this is one of the problems I have with the CBO scoring, okay, is that they say, well, on the basis of the numbers that we see in front of us, we're going to see an increase of 2.5 $2.4 trillion in the deficit. Congressional Budget Office is using what they call static scoring. All right. They're not using a dynamic scoring model. And what that means is when you use a dynamic scoring model, you're taking into account the effects on personal behavior that tax policy has. Let me give you an example. If we had a tax overtime income of 100%, all right, 100% tax on overtime income, how many people would work any overtime hours?
None.
Zero people would work overtime hours. And so you can say, well, listen, 10 million overtime hours worked in the United States of America every year. If we put 100% tax on those overtime hours, we would collect, you just do the math and you figure it out. That's called static scoring. And so these eggheads sit down and they say, oh, we could raise $15 billion if we tax 100% of overtime. No, you won't raise a single cent because nobody is going to work for nothing. That's dynamic scoring. Dynamic scoring takes into account personal behavior, all right, how people individually react to tax policy. Static scoring just does the math, all right? And so when CBO does its static scoring, it doesn't account for the fact that people will work harder when they are allowed to keep more of their money. And so what happens is in that scenario, the government almost always ends up collecting more revenue at lower rates than it otherwise would at higher rates because people have an incentive to work, all right? What you tax, you get less of. And so when people have an incentive to work, they will work more when they know they can keep more of their own money. And so to the extent that the CBO says there's 2.4 trillion added to the deficit, that is likely not going to materialize because government will very likely collect much more revenue under the lower rates than they otherwise would at the higher rates.
Well, that's all for this week. Thanks for watching, taxpayers. And remember, there's no such thing as a hopeless tax case. If you think yours is the exception, then call the office or visit our website to get a hold of Dan here, and he can help you see the daylight. Dan, tell them where else they can follow along with your Taxpayers' Rights Crusade.
Yeah, follow me at Pillow Talks Taxes. I'm primarily on TikTok, Facebook, True Social, right here on YouTube. Make sure you subscribe, like, and share these videos, especially with your federal and state representatives. And if you've got a tax problem, go to my website right now, TaxHelpOnline.com. Buy any book at any price point off my website, and you get a free 15-minute consultation directly and personally with me. So go to TaxHelpOnline.com right now.